Hello, everybody. Welcome. It looks like we've got a whole lot of folks here today, and that's great. Thank you very much for joining us. We're excited that you're here today with us, and we're equally excited to have Apollo Lupescu from Dimensional Fund Advisors joining us as well. Dimensional is one of the world's leading money managers with over 40 years of success utilizing the science of investing to design investment portfolios, and they manage over $679 billion in assets. They're one of the largest money managers in the world. They've been on my investment policy team for over 11 years, and they have helped many of our clients to make good decisions during difficult and chaotic periods in the economy and in the markets. And that's why we're here today. We want to discuss what's going on in the world, what's going on here in America, and what should we be doing as investors. Apollo is a vice president at Dimensional with his PhD in economics. In his current role, he's known as the Secretary of Explaining Stuff, and that is a very technical title. He's sought after as an industry thought leader due to his unique process of taking complicated economic topics and boiling them down in a very understandable way. We're very excited to have him here today to hear his thoughts on a number of topics. We're going to talk about inflation, the war in Ukraine, the Fed and interest rates, supply chains, recessions, even how politics and midterm elections can play a role in what we do. So everything that's timely and on your minds today, I believe we're going to come across. And we want today's event to be interactive with all of you. We like to get together in person, but in today's world, it's not as easy to do that. So we want you to be involved this way as well. If you have a question in mind, we want you to go ahead and submit it. At the bottom of your screen, you've got a Q&A button. Go ahead and click on that. Everything you put in is anonymous. Nobody will know who's sending it, but please send us any questions, anything that's top of mind. And even if it's during the presentation, we don't mind stopping what we're doing, answering your questions and making it interactive. We'd like this to be a town hall type event and have you here with us. So don't hesitate to ask a question if you have one. And otherwise, sit back and please enjoy what we have to say today. With that being said, I'd like to get this started and hand it on over to Apollo. Thank you.
Ryan, it's a pleasure to be here, and thank you for the invitation, and thanks to everyone for taking the time to attend today. And there's quite a bit to talk about because, particularly if you open the newspaper or you listen to, anybody in the media, there's so many big stories around investing today. And you touched on those, Ryan. It's inflation, and what does it mean to our money? It's the war in Ukraine. It's the Fed raising rates, and all these things that are impacting the markets. And what I want to do is maybe take a step back. And before I get into these topics, I want to suggest maybe something different. What I observe myself watching the news and reading this is that quite often there's a certain narrative that comes out of the media. Oh, the market went up today because the rates went down, or whatever the reason might be, or the market went down for whatever reason. And there's a sense that we can explain the market movements and we can somehow relate what happened into one thing, like whether it's rates or the war or inflation or recession, whatever you name it. All these things that we hear about, there's a sense that we can directly translate into how will the market perform. And what was interesting to me is that these narratives are helping us understand something that is really hard to comprehend. And a lot of times we want simplicity. There's beauty in simplicity. It's easy to understand. The Fed said something, the market went up or down, and that's easy to understand. The question that I want to pose to you today is are these narratives consistent with data and evidence? And the reason I want to talk about data and evidence is because if we look at everything around us, from businesses in the way that they make decisions, into ourselves, you look at all the data that we have on our watches and everything. The whole world right now, medicine is another great example where the decisions that we make are no longer driven by a narrative, an observation, a hunch, but they're really driven by data. And what I want to do is take some of these big issues and confront them with data and say, what does the data say when we talk about all these things? So I'm going to start with the big one, which is inflation. And Ryan, I'm hoping that if people ask questions, I love that you wanted to ask questions from the beginning. Don't wait for the end. If it's something that I say that you need to clarify, please go ahead and do so. But the first place is inflation. And we don't need to read a paper. Just show up at the just show up at the market or the gas station. And it was so. I mean, here in Los Angeles, gas is about $7 a gallon. It's quite expensive. So prices are going up. We see that around us. And there are two questions. One is, is this going to last? But secondly, how do we negotiate that with investing, and is it good or bad for our money? So when you think about inflation, the one perspective that I've always had relates to my firm belief that the best societies and the best outcomes happen when you let the markets work. In other words, you allow supply and demand to work properly. You let them do their thing, and eventually supply and demand will tend to adjust to reflect the realities of the moment. And if you put the world in that context, I think that the way it ties into inflation is that, as unpleasant as it is for us to see prices going up, it is to some degree a necessity. And the reason I'm saying it's a necessity is because it reflects right now what's going on with demand. And demand means like what we're buying as consumers, what companies are buying, what the government is buying. All of these entities, the government, consumers, and companies are buying things, and they create a certain demand. And on the other hand, you have the supply, not just in the US, but the supply, which is the global economic production on all these different levels, whether it's toys or gas or you name it, oil. And right now, what this free market's reflecting is that the demand is still pretty strong. I mean, people want to buy things. It's just that on the supply side, we are not producing as much. So think about the alternative of prices not going up. Let's say the gasoline, instead of being $7 a gallon, it's $1 a gallon, which is back in Michigan when I lived there. That's kind of what it was 30 years ago, $1 a gallon. Now imagine the gasoline was $1 a gallon. Right now at $7, I'm actually really careful where I drive. I really don't want to take long trips for no reason. So I'm being mindful. I know people are changing some of their driving habits to reflect the fact that prices are high. And when that happens, people are not buying as much. And because they're not buying as much, it allows us to have gasoline at the pump. If it was $1 a gallon and everybody was using it nilly-nilly, we would run out of it in minutes. That's exactly what happens in Venezuela, where the government controls the prices and keeps them artificially low. You cannot get it because they're too low. The country doesn't produce enough gasoline. So to me, the inflation is somehow reflecting of, at the moment, that we just don't produce enough of certain things, and those things are going up in price. But there's nothing really horrific about that, as long as the markets are allowed to operate. Because what you see is that when the markets operate, their entrance in the market, people are saying, well, I can produce this a little bit cheaper. And then, you get market share by doing that. And then consumers kind of are smart enough to shop for the lower price if everything else is the same. So to me, the market is such an important concept, and inflation being up, it's not pleasant. It's a little bit necessary. But what we see invariably is that the markets tend to work it out. The issue is when the markets are not allowed to work. And Ryan, I'm not going to put you on a spot because I got this question not too long ago, which was, when did we have the highest inflation year in this country since we have good economic data for about 100 years? And I didn't know. I mean, if I can ask you folks on the call, like, what do you think the highest inflation was in the US over the past 100 years? And my first instinct was, well, late 70s, early 70s, early 80s. I mean, just around that time. But it turns out that the highest inflation that we've seen in the US is not in the 70s or early 80s. In fact, it was in 1946. And why 1946? I know the war had to do something with it, but why not during the war? Why after the war? And then I started looking into it, and what I found out is something quite remarkable. That as we transitioned from an economy that was really consumer-oriented to one that was producing goods for the military, the government tried to protect the American public. And what the government did, and this is true, back during the war, it introduced something called the Office of Price Administration, or OPA. And OPA published in virtually the prices that could be charged from a bowl of chicken soup in a restaurant to a can of beans to a pair of pants. Everything was tied into the OPA, and in fact, markets were not allowed to operate because you had this control, the price control coming from the government, and once you reach the price, the ceiling, you couldn't charge any more of that. And not only that, but people were encouraged not to skirt the rules. And in fact, there were brigades of volunteers who would turn in the offenders who might raise prices beyond what they had to do. So, what were they allowed to charge? So think about this. For years during the war, you had supply and demand not allowed to operate, and prices really got compressed for years. And then in 1946, what you see is that the OPA is eliminated. So in 1946, guess what happens when you have years of compressed prices and you release that valve? Prices are going to shoot right up. And that's what we saw in 1946, an inflation of about 18%. 18% inflation in 1946. We had similar situation in the early 70s when we had price and wage freeze because of the transition from the gold standard. And every time we see something like this, well, there's a chance of perhaps high inflation. But by and large, what we've seen in the economy is that these don't really, really last very, very long. Now, today, there are two very distinct narratives. And on one side, the narrative is saying that, listen, it is something that's going to last longer because consumers are getting used to paying more, workers demand higher wages, and that's going to lead to a price wage spiral that's going to keep inflation higher for longer. That's one scenario that investors are certainly considering. The other one is, saying that this is a transitional phase. We had a economy globally that was affected by COVID. Now we're getting into a different stage, and soon enough, we're going to resume production than what we used to. And at that point, the price growth of inflation is going to be pretty much what it used to be. And right now, both of these narratives are legitimate. I can make a solid argument for each. The trouble is that nobody really knows, but that doesn't mean it's hopeless. Right now, there's something that I think of as a referendum. And in this referendum, investors vote with actual dollar bills, billions and billions of dollars, in the way that they see these two scenarios and the way they buy and sell different types of bonds, some related to inflation and some not. And what's fascinating is that this metric, which is called the break-even inflation rate, it's not a household metric, but to me, it's one of the best ways to understand the market signal. What is the market signaling that we should expect for inflation over the next few years? And there's a 5-year break-even inflation rate. There's a 10-year inflation rate. So I'm going to share with you the actual Fed website that keeps track of this particular metric. And this is the Federal Reserve of St. Louis. And this is the 5-year break-even inflation rate. And since, again, it's not a household name, let's just go ahead and read exactly what it is. The value implies what market participants expect inflation to be in the next 5 years on average. That's what I think is so important, is because it's, when you have these two different opinions kind of put together into the hopper, that's what this number delivers, not one opinion or the other, but just a combined wisdom. So what do we see? Over the past 5 years, we have had unusually low inflation. The long-term average inflation is about 3%. The Fed has a target of about 2%. Over the past 5 years, we've been roughly at about half the long-term inflation. So very, very low inflation. And when the pandemic started, we had a different issue, the fact that the prices might not grow. And that's a problem by itself. And, as we reopened the economy, things got back to normal. Where we are today, in fact, as of last night, I can probably zoom in here. As of last night, which is Monday night, or actually, there's probably a Tuesday somewhere. Yeah, there's got to be a Tuesday somewhere here. There you go. Or Monday, Tuesday, doesn't matter. As of a day or two ago, the expected average inflation over the next 5 years is about 3%. What do you see on the news right now? It's about 8%. And to me, what the signal that the market's it's sending is that the inflation is going to be higher than we've seen the past few years, but it doesn't seem like the message is that this is going to be an outrageous inflation over the next 5 years. That's what the market signal is. When you look at supply chain, when you look at wages, when you look at shipping, when you look at everything out there, that's the signal that the market is sending. We're looking at about a 3%, which is, by the way, 3% is the long-term average. So right now, at least the market signal is that inflation is high today, but our expectation is that over the next 5 years, it will not continue at this pace, but rather it will average out at about 3%. So I think this is a really important thing to know, that there are different opinions. And when you look at the data, it's hard to make an argument for one scenario or the other. What you're better off is looking at the combined wisdom and the way that investors vote with their dollars. So that's the first thing. The second thing is this idea that inflation is really terrible for the stock market. And when you look at inflation, that's going to be devastating for the stock market. So one thing that we did is we took all the inflation years from the lowest in 1932 at about negative 10%, which is the deflation concept, to the highest in 1946 at 18%, as I mentioned. And then we cut this in half. We discard the lower half, and we only look at the above median inflation years. And we asked the question, how did the stock market do when you account for inflation? In other words, when you account for inflation in these above median years, did it lose value or did it actually outpace inflation? So when you looked at the data, it's quite interesting. When you look at stocks, the entire stock market, what you see is that the stock market delivered to investors inflation plus 4.9% on top of it. So these are what's called the average annual real returns. And on average, even if it's an above median year, the market not only that delivered inflation to investors, but on top of it, it was 4.9%. And within the stock market, you have the technology stocks and other companies known as large cap growth. These are large, mature, well-established companies. And they have also outpaced inflation. They stayed ahead of it, not as much as the market as a whole. But for people who want to diversify, and instead of large, they do small, and instead of growth, they do value. What's been interesting is to see that small cap value has also significantly outpaced inflation. So if you want to stay ahead of inflation, what's so interesting is that the way to do it is to really have a diversified allocation, and the stock market has actually been able to outpace inflation over the long run, even in above median inflation years, which is again not something that you typically hear. So when you look at the data, again, I looked at the data. What are the two main key ingredients here? Number one is that you look at the data and you see that the inflation over the next 5 years is not expected to stay at the same clip as it is today. It's rather much closer to the long-term average. And then secondly is that when you look at the stock market, it actually has been a good place to outpace inflation on average over the long run. So both of those, I think, they're pretty good scenarios for investors. The second topic that quite often you hear in the media is about the war, is that we have this war in Ukraine, and this can be good for the market. That wars are terrible, conflicts are really terrible for the market. Let me start with just the reality that it's a very emotional thing. To watch these images and to see all the suffering, it's really hard. And quite often, at least in my case, I've translated that emotion into some anxiety about what might be coming down the road. And I think it's normal. I think it's understandable if somebody has that. The question is, when you look at the data, what do we see around conflicts? What do we see around, big events like this? And this is what has been interesting to see. If you look at the date before the war began, January 1st, the 23rd of February. The invasion was on the 24th. So if you look at the period before the invasion, and you have about 5 weeks or so in that time frame, 5-6 weeks or so, and you ask, well, how did the market do up until that point? Well, up until the day before the invasion, the U.S. stock market, the S&P 500 index, was down 11 to 12%. Now, what happened as the invasion began, and you now fast forward 5 weeks into the war? How bad was it for the market? Because again, that's the narrative, that the war is terrible for the market. Well, it turns out that for the first 5 weeks of the war, between the 24th of February and the end of the quarter on March 31st, the market was actually up 7%, up 7%. So it's, again, when you look at the evidence, I can't tell you that the war by itself is going to be a devastating blow to the stock market. In fact, the market went up. And again, you look at the data. How much is the market driven by what happens in Ukraine and Russia? Well, the stock market is about companies earning money. It's all about profits. You buy ownership into a company, and the value of the ownership is in the cash flows that you expect to receive as a business owner. So ultimately, the value of the market comes from what do I expect to make from that company years and years and years down the road. And it seems like the message that the market's sending is that the war is not really impacting corporate profits as much as one might believe. And let's just take some real examples. You can go, as of today, the 17th of May, if you look at Netflix, it lost about 68% of its value. How much does it have to do with Russia and Ukraine? You have Facebook lost, almost 40% of its value. And on the other hand, you have a company that exited the business, Coca-Cola, and they're probably making money there. And guess what? For the year today, it is up about 11%. So the message of the market is that Russia and Ukraine is as impactful as it is emotionally. It's not affecting corporate profits as much as one might believe. So that's sort of interesting. Now, people have asked me, okay, but what if we actually go into a more prolonged conflict? So it's not just about right now, but if you go down the road and now we have some sort of a Cold War like we had with Russia, wouldn't that be bad for the market? And I looked at the data. Again, what does the data say? And I looked at the S&P 500, which is a broad measure of the U.S. stock market. And I first looked at the Cold War era, which, from all historian perspective, it starts around March of 48, roughly to the end of 91 when the Soviet Union collapsed. And as I said, the long-term average of the stock market's about 10%. What we saw during the Cold War, which are years of the Cuban Missile Crisis, all the nuttiness, all the money that we spent on defense and all this stuff, what you see is that the market, on average, had an annualized return of 12.7%. So really nice return for investors, even as we had to deal with the Cold War. I'm not arguing that Cold War is good for business, not at all. Because there are disruptions, there are money, the government spending, there are all these issues. What I'm saying is that the markets find a way, companies find a way to make it work. Now let's look at the post-Cold War. This is when we won, the globalization, everything looks good. We're on top of the world. How did the market do? If you look at the post-Cold War era, from the 92 to the end of last year, what you see is that on average, the stock market returned 10.6%. And again, I'm not arguing for a Cold War just because the market might be doing well. Not at all. All I'm saying is there is no strong evidence to suggest that even if we had a Cold War, that's necessarily going to be terrible for the market. There are a lot of other variables that drive the stock market performance rather than just just the geopolitical events of the time. And even in World War II, I mean, an interesting statistic that always blew my mind in some ways is that if you invested $1 at the beginning of World War II in September of 39, by the end of August of 45, that dollar would have pretty much doubled. A dollar would have turned into $1.98. So let's just say $2. So you would have doubled your money in the stock market in the US in the S&P over the course of World War II, which is an incredibly devastating time. Again, so the point here is not that war is good for business, not at all, because war is not good for business. This is just not. You don't have consumers buying and there's just so much disruption in the world. The point is that companies find a way to make it work in whatever situation we might find ourselves into. So that's for the war. And the last thing that I will say is that the way that you think about investing and look at the data is that some countries like Russia and Ukraine, if you're going to be an investor, you also have to think, how much money do I want to allocate to those countries as a percentage of the overall global portfolio? And right now, if you redraw a world map where you plot the value of companies in each country instead of landmass, When you add up the value of all, let's say, all these companies in the U.S., Apple, McDonald's, Coke, you name it, what you find out is that a global map will suggest that from a data perspective, all the U.S. companies amount to about 57% of the value of all stocks. And there are roughly about 3,600 different companies in which you can buy ownership. And then there is an international developed set that has about 30 countries or so, that is about 7,400 companies. And then a third category of emerging markets like China, Korea, India, and Brazil. And Russia was part of this emerging markets a group of countries. And what's fascinating is that Russia doesn't have a tag just because it's a very small country. I can't even tell exactly, where it is. Is this Russia or is this Russia? I mean, on a global scale, they're about less than 1% of the emerging markets, which means that on a global scale, they really are not a big player. So when the Russian market imploded, to most investors who are broadly diversified, it was a non-issue. Because the exposure to these Russian stocks was minimal, unless they had some managers who placed some bets in that part of the world. So we talked about inflation and putting some data to work, whether you look at the long term or you look at what to expect over the next 5 years. We looked at the impact of conflicts around the world on markets. And the third piece that I want to address is the Fed. Because we've heard a lot about the Fed. The Fed is raising rates. The Fed is the rates are going up. Well, the first reality is that the Fed is only controlling one single rate, and that rate is called the federal funds rate. It's not controlling all the other rates in the economy. So the federal funds rate is one of the many interest rates that exist in the economy. And I'm just going to, show you some data. When you look at the federal funds rate over the past, 30 years or so, what you see is that in the when you look at this, when you look at this federal funds rate, it did actually change from year to year. So you do have years when the federal funds rate might be going up by about 1% or so in 2000, and that's happened. But the following year, the federal funds rate, which is what the Fed supposedly controls, it went down about 4.5%. There are many years when the Fed fund rate does not change, and again, this is the only rate that the Fed directly controls. And what the Fed is really trying to do is influence other rates based on this baseline rate. How successful are they? Do we see that other rates moving lockstep? And again, there are hundreds of different interest rates. There's an interest rate on a 1-year government bond, another interest rate on a 5-year government bond, 10-year government bond, corporate bonds, all these different ones. And certainly it's cherry picking, if you want to call it that way, but it's not. It's really, you have to find an interest rate that is well known out there. It's the 10-year treasury, because quite often is associated with the mortgage rate. And I just thought, let's just as an illustration, as a case study, try to see how does the 10-year treasury yield change in response to a Fed fund change. And the change means, what's the difference between the beginning of the year and the end of the year? That's the change in the rate for that particular year. So we wanted to see, do they move in lockstep? When the Fed drops 4.5%, like in 2001, is the 10-year treasury also moving down by 4.5%? That's kind of the idea that we wanted to explore. So when we actually did the exercise and we looked at the 10-year treasury yield, what was surprising to see is that it doesn't necessarily have to move in lockstep. There are some years, like in 2019, when it did. They both kind of moved in lockstep. I can also show you a lot of years when it didn't. This is in 2000, the Fed fund rate went up. The actual 10-year treasury went down. Here we had a huge drop in the Fed fund rate. It didn't budge for the 10-year. Look at all these years when there was no change in the Fed fund rate, and yet the 10-year was all over the place. In other words, what I'm suggesting is that the federal funds rate might be one of the variables that impact the 10-year treasury yield, but it's not the only one. There's some other variables that might drive that particular rate. It's the supply and demand that we talked about. And it doesn't seem that it automatically you can make the connection to say, if the Fed is raising rates, I know exactly what's going to happen to the 10-year treasury. No, the data doesn't say it. You can actually make that solid prediction. So it's good to know that just because you hear that the Fed is raising rates, it might not be the case that all rates will move in lockstep. They could, but it doesn't have to. Now, what about the story that the market has been really fueled by the very low rates? Companies could borrow very inexpensively, but once you raise the rate, it's going to cost them more. It's more expensive to borrow, and that's not going to be good for them, and the market's going to drop. It's certainly something that we hear a lot, and I wanted to confront that with data. Have we seen, let's say, over the past 20 years or so, periods when the Fed fund rate went up? And in fact, when you graph that, just visually, can you see a couple of periods when clearly the Fed fund rate went up? And the first one is this. Of course, in 04, 06, we had a jump in rates. They were about 4.5% or so. So quite a significant increase in rates, 3 years in a row, back to back to back. And the second one is what happened here in 2016 to 2018. Once again, back to back to back increases in interest rate that particularly came after a very low interest rate right before that. So it seems to me that we have a reasonable place to start and say, okay, we have seen perhaps situations where the Fed fund rate changes. What is the market doing? Because again, the narrative is that this is not going to be good for the market. Well, let's look at the first period, which is in 04, 06. And if you go year by year, what you see in 2004, the first year when we keep seeing these increases, the market was up 10.9%, which is a little bit about long-term average. The second one was about 4.9% on average in 2005. And for the third year of subsequent increases in rates, the market was up 15.8%. In other words, when I look at this, there's not like a clear evidence saying that rates are going to go up. That's a disaster for the market. Interest rates are probably one of the many variables that drive company profits. There are many others, and it doesn't seem that this is a primary variable, that it's a direct connection. Rates go up, market goes down. It's just not in the data. What about the second period? Well, in 2016, the market was up 12%. In 17, a whopping 21.8%, which is a big number. It's more than twice the long-term average. And in the third year, in 2018, we finally had a down year at about negative 4.4%. So again, what this is suggesting to me is not that Fed fund rate increases is good for the market. It's just simply suggesting that as an investor, you can draw these simplistic correlations that rates go up, markets go down. It's not it doesn't have to be, could be, but it doesn't have to be. In fact, over the past 20 years, 5 out of the 6 years when the rates went up, the market actually went up as well. So again, it's looking at the data, and the data is not suggesting that this is necessarily imminent trouble for the market. There are a lot of other variables that might drive profits for the market. Now, one of the concerns is that as the Fed is trying to fight inflation and raising rates, perhaps the economy might go into a recession. And that is certainly a concern to a lot of folks, because as you're trying to reduce economic activity by changing some of these rates, then companies produce less, they don't invest as much, people might not buy as much. Look at the mortgage rates have been going up, and it becomes more expensive. So it is a concern to some people that maybe when you try to do this, the economy might land into a recession. And we haven't heard that word for a long time. And certainly there's a possibility of that. Nobody really knows. A lot of folks are hoping that the Fed can navigate the high inflation without really dipping into into recession. The question is, if there's a recession, how bad is it for your money? Does it necessarily have to be horrible for your money? And again, I come back to the same idea. There's a difference between the economic activity right now and the stock market, which involves ownership. And ownership in companies, it's not just for 2022. In fact, that to me is the big difference between the economy and the market. The economy is a snapshot. It's a frame. If you remember the good old films, the economy is what's going on at the moment right now. Unemployment, economic output, price levels, all of this have to do with a snapshot, a scene, a frame in the economic picture of the country today. But stock market investing is not about today, but it is about the future, because you're buying ownership in these companies, and the value really reflects the cash flows that they will generate for years and years and years down the road. In other words, the stock market is forward looking. 2022 is just one of the years, but the reality is there are going to be many, many years down the road when we need to evaluate what the corporate profits might be. And I think that's where you see quite often that the recessions don't always have to follow that path, that the recession happens and the market tanks. And if we look at two examples, we look first at 1980. In 1980, we had a very bad recession. We had very high unemployment. The unemployment was huge. The GDP, the economic output was low. The inflation was high. Housing starts were dropping significantly, about a third or so. So we did have a really bad, economic year in 1980. And what you would expect in a terrible year like that, particularly as the Fed is also raising rates, it's like a perfect storm that everything will lead to the market doing really poorly. And yet in 1980, a very bad recession, what we saw is that the market actually went up about 32%, a significant increase in the market. So it didn't necessarily have to correlate. It's possible that the market might go down, but it doesn't have to. The other big recession we had it was in 2009. And we all remember the 2009, which is a terrible year. And look at the data. What is the data? How did the market do during the worst crisis since the Great Depression, as the media was putting it out? Well, it turns out that as bad as 2009 was, and it was the worst year of the economic downturn, economically speaking, what you saw is that the stock market in 2009 was up a whopping 26%. Now, why is that? It's because the markets are forward-looking. The markets are seeing, there's light at the end of the tunnel. It will get past this, and then there's, a pretty good future for some of these companies. And that's what they're pricing in, even as we are in the middle of a recession. So just because you hear the word recession, again, markets are forward-looking well beyond the recession, and it doesn't have to be that the markets will go down in a recession. I'm not going to promise you they're going to go up, not at all. All I'm saying is that there is no evidence that it's an automatic link. It could be, but it doesn't have to be that way. So we touched on, Ryan, so far on inflation. We looked at some data there. We looked at the war in Ukraine and conflicts in general and how they impact the market. We looked at the Fed and their rates. We looked at the economy and the stock market. And the last thing I want to touch on is just something that there were big news yesterday. We had some primaries, and we're going to have more elections in the fall. And this is one time when a lot of folks are wondering about politics. And how is politics impacting their money? Should I be doing something in response to the outcome of an election? And really, the big one was about 2 years ago when we had the presidential election. But even now, a lot of folks are considering, what does it mean that we might have either Republicans coming back in or Democrats staying in power? And to begin with, Ryan, this is a very touchy subject because it is touching on our, deeply held beliefs, our core identity and values. And because of that, it's very emotional. And I want to acknowledge the emotions that come with investing. What I want to do is be very pragmatic and look at how do elections and political control impact the stock market. That's the issue that I want to look at. So not to say that one party or the other is better, not at all. It's just simply saying, when you look at the data, what does the data say? And 2 years ago, remember we had that election in Georgia where, in January, I think it was announced that the Democrats had what's called unified government control. In other words, they control the White House, the Senate, and the House. Not that they're holding hands and singing "Kumbaya," but it was a unified government controlled by the Democrats. And a lot of folks are wondering, well, what should I expect from a market perspective? Because we now have this unified government control. What we did is we looked at the data. And we started with the Republicans and asked, did the Republicans control the House, the Senate, and the White House over a number of years? And we went back to 1920s. And this is what we found out is if you go back to 1920s, there were indeed 13 different years of unified Republican government control. So they control the White House, the Senate, and the House. So it is, they've had this control themselves. And the question is, how did the market do when they had it? What does the data say? And when we looked at data, what we found is that on average, simple average, over that time period, the market went up by 14.52%. That was the average return for those years. So that's the Republican side. But now we have the Democrats. The question is, did the Democrats also have this unified government control? And the answer is yes, they did have it, but it wasn't for 30 years. And I had no idea, but it was interesting for me to find out that they had it for a lot longer, 34 years that they had this unified government control. So the Democrats had it too. And the question is, how do the markets do on average during these 34 years of Democratic unified government control? And we ran the numbers and the answer is a bit of a drum roll, 14.52%. It is identical to the second decimal. That's how little it matters the political party in control. Politics is one of the many variables that impacts company profits, but it doesn't seem that having one party or another is necessarily a recipe for success in the market or a disaster in the market. So to me, when I look at the data, again, so many folks are getting caught up in the politics and making moves with their money because of what might happen. When you look at the data, what it's suggesting is that politics should not play a role in the decisions that you make about your money and what the market might do. So ultimately, Ryan, I want to touch on these five elements of current news and really look at the data. And what we find is that, every single time the simple narrative that is being put out there in the media is not really consistent with the data. It's not what you hear, but again, when you look at the numbers, that's what they seem to indicate. So ultimately, I think that the good news is that an investor, just after all this, so what does it mean ultimately? What it means ultimately is that if you have an asset allocation, if you have a plan, financial plan, and Midwest Heritage did the plan, and you have a balanced, diversified allocation, that is going to give you the best chance of achieving your goals, a better chance to achieving your goal, if you put it that way, relative to moving it out of the market or trying to make all these plays or trying to listen to all the pundits, because there's so many things moving the market, and it doesn't seem to be that any of these are the one thing that you can link directly to market movement. So because of that, the best thing to do is have a balanced portfolio based on a plan and make sure that you're globally diversified, not just in the US, but globally. And also to the degree that you want to add a diversification component to small companies and value stocks, they can also benefit at all. And that particular strategy, that asset allocation, the disciplined strategic asset allocation, we think gives you better odds of achieving your goals rather than listen to these simplistic narratives in the media.
Wow. Thank you, Apollo. That was very insightful. Every time I hear you talk and hear the other folks at Dimensional and the other thought leaders talk, I end up coming away with 10 things that I didn't know that I'm going to take into my practice that's going to help me to help my clients to navigate this stuff. This was incredible. Thank you. I think you did such a good job that you answered people's questions before they even had them. And we didn't have as much coming through that way as we thought, but we did have some come through. And I want to put you on the spot with one question that a lot of people have been asking, and it's about supply chains. Yes. We can't get ships into our ports and we don't have truckers to move them even when they get in. How are we going to solve this problem? How is inflation ever going to come down to the 3.08 that we're, projecting with the market if we can't get our goods and services? Do you have, and you may not have data to back it up here on hand, but you probably have it in your head. Do you have any thoughts on that?
Yeah, I mean, it's the supply chains is certainly a big issue right now because, as you said, it's not just in the U.S., but you have countries like China, where in certain parts, like in Shanghai, they are really trying to impose a zero COVID policy, which means that they're in lockdown. They've been locked down for a long time, And whenever you do this, then you're impacting the manufacturing that happens in that area, but also the shipping and the way that goods are transported. So I do think that this number that you saw, the 3.0, that's an average over the next 5 years. So it doesn't have to be that this particular year we're going to see necessarily a much lower inflation. It could be. What we're seeing right now, at least in the data, just when you read out there, is that consumers are actually starting to not only moderate their purchasing, but be smarter in the way that they buy things. And companies that were able to kind of push some of these price increases, the folks are kind of saying, I'm going to buy something that's perhaps a generic person, a lower cost. And not all supply chains are really tied to just one area. So supply chains, it's a very broad word, and we're kind of focusing on one area, which is a big trade partner, but there are tons of other supply chains that are still functioning properly. And so in that respect, what we see is that the market right now is reflecting that some of these supply chains are going to take some time to work themselves out. And I wish I had the crystal ball, and I do have one, but it's different, that would tell you exactly how long it would take. It's just that I'm a firm believer in companies finding ways to make it work. That's my firm belief. And I'm going to give you a quick example, which doesn't have to do with the supply chains, but hopefully you can tie it in. And I hope I don't really insult anybody, but in San Diego years ago, they put a regulation in place saying that you can't drink on the beach because locals got fed up with the drinking on the beach. And what those folks did eventually, they figured out a way in which they can still enjoy a beer, but instead of the beach, what they found is that if you go 10 yards out in the ocean on a floaty, that's a perfectly fine thing to do. In other words, companies and individuals find ways to make it work. If I cannot get it this way, I'm going to find an alternative. So, I'm not sure to what degree that's possible in every case, but I'm a firm believer that companies will find a way to navigate and make it work. And it might be hard. I have no doubt about it. For some companies, it'll make it work, but I don't see this as a permanent impediment. I think that this issue won't be much longer. We've had 2 years of a pandemic. If we could navigate the 2 years of the pandemic, and Ryan, let me ask you, do you remember 2 years ago, roughly this time, what you and I were doing?
I do, yes.
We're locked down at home, where even walking outside the house seemed like an adventure. And imagine how we felt back in those days. Forget about supply chains. That was a terrifying experience where 2 years later, things are kind of returning to normal, not exactly the way it used to be. So if you create some context, you see that, that we have been through perhaps worse than these supply chain issues. Again, look at oil. Do you remember oil 2 years ago, Ryan? 2 years ago, we had a big story on the national news that the cost of oil, the price of oil was negative. If you wanted to buy oil 2 years ago, roughly, you didn't have to pay for it. If you got the oil, you would have gotten paid to have the oil. And today it's $100 a barrel. So it's very expensive. Again, things change. So all of these things are the companies adapting in a free market. And so I have no answer to know exactly when this will happen, but I have no doubt in my mind that companies will work it out. And this is not a permanent state. This is a phase that eventually will come to an end.
And I think we can all relate to companies and people adapting. We've all had to do it. We've all worked for companies that we see that happen. And I love your phrase, people vote with their dollars. If inflation is there and there is competition that comes in, people will vote with their dollars. And by nature, inflation and demand and supply tend to line themselves up. So exactly. I think that's great.
And companies see opportunities. If the prices are so high, well, I'm going to find a way to produce something at a lower cost. And I'm going to get market share. One of the most interesting theories from a business perspective was put forth by Clayton Christensen, who was a professor at Harvard MBA, and his idea of a disruptive entrance to the market that started the lower end by offering a low-cost product and eventually get market share and then compete with the big boys and the big girls. So to me, that's a situation that right now can play out.
That's great. That's great. I think you've answered every question I had. I think you've answered all the folks that are on watching their questions. This has been incredibly insightful. Thank you. Thank you very much for your time. I look forward to doing this again with you. This was great.
Me too, Ryan. Thank you so much for the invitation, and thanks to everyone for taking the time. It's great fun talking to you.
Yeah. You as well. Take care. Thanks, Apollo. Thanks everybody for coming. I hope you enjoyed this time. Please reach out if you have any questions. We're happy to visit with you, go over any concerns you have, and hopefully everything's going well. So thank you all. Have a great day.